They told you renting was throwing money away, that homeownership was the dream, and renting was just a stepping stone, temporary, wasteful, something you'd outgrow. But what if renting isn't the problem? What if the real cost isn't what you pay each month, but what you lose without ever seeing it disappear? Picture this: a young couple in a one-bedroom apartment, third floor, no elevator. They've been there for years. The rent started at $1,200. Now it's $1,750. They've paid over $60,000 into that building, and they don't own a single brick. But the cost isn't just the money. It's the nursery they can't paint, the dog they can't adopt because of a no-pet clause, the job offer across the state they turned down because breaking the lease meant losing 2 months' rent. It's the retirement account they haven't started because every bonus goes to covering rent hikes. It's the generational wealth they won't pass down because they're building equity for someone else. This isn't a story about irresponsibility. It's about a system that has quietly shifted, where renting has gone from a temporary choice to a permanent trap for millions of Americans. The real cost of renting isn't visible on a lease agreement. It's measured in opportunities never taken, security never built, futures never realized. And across the country, in cities and suburbs and small towns alike, that cost is compounding in ways no one is talking about. Until now, renting used to mean freedom. It meant flexibility, the ability to move for a job, test out a neighborhood, avoid the burden of a mortgage you weren't ready for. It was a choice, a phase, a logical step in the American economic journey. You rented in your 20s, saved in your 30s, bought in your 40s. That was the script. But that script has been rewritten, and most people didn't notice until they were already locked in. What changed? The math broke. In 1985, the median rent in America was about $400 a month. The median home price was around $75,000. A renter could save for a down payment in 3 to 5 years if they were disciplined. Today, the median rent is over $2,000 in many metro areas, and the median home price has surged past $400,000. Even with perfect credit and steady income, saving for a 20% down payment now takes the average renter over 15 years, if they can save it all. According to reports from housing policy institutes, more than half of American renters are now cost-burdened, meaning they spend over 30% of their income on rent. Nearly a quarter spend over 50%. That's not a budget. That's a trap. The mechanisms stacking up are relentless. First, there's wage stagnation. Real wages for middle-income workers have barely moved in 2 decades, while rent has climbed year after year. Second, there's the investor surge. Private equity firms and institutional investors have bought up millions of single-family homes, converting potential starter homes into rental properties with algorithmic rent pricing designed to maximize profit, not affordability. Third, there's the supply crunch. Zoning laws, construction costs, and NIMBY opposition have choked new housing development in the places people actually want to live. Fewer homes means higher prices. Higher prices mean more people stuck renting. More renters mean landlords can charge more. It's a feedback loop with no exit. Consider a schoolteacher in Denver. She makes $58,000 a year. Her rent is $1,900 a month. After taxes, utilities, car payment, student loans, and groceries, she has about $200 left. She's been trying to save for 3 years. She has $4,200. A down payment on even a modest condo would require $60,000. At her current rate, she'll be renting until she's 50. But the financial cost is only the surface. Beneath it lies something harder to quantify: the psychological toll. Renters live in a state of permanent impermanence. They can't put nails in the walls. They can't renovate the kitchen. They can't plant a garden or build a fence or install shelves without written permission from someone who holds all the power. Every year, the lease renewal notice arrives like a ransom letter. Will the rent go up $50? $100? $200? There's no negotiation, no appeals process. Just accept or leave. And leaving means first month, last month, security deposit, moving costs, often $5,000 to $8,000 up front for the next place. It's cheaper to stay and pay more. The system knows this. Landlords count on it. Rent hikes aren't random. They're calculated. Software platforms now allow property managers to monitor competitors' pricing in real time and adjust rents dynamically, the same way airlines price tickets. If every landlord in a zip code raises rent by 10%, where do you go? According to data from real estate analytics firms, Rent increases have outpaced inflation by double-digit margins in over 60 metro areas since 2020. It's not just market forces. It's algorithmic coordination. And renters have no leverage. A single mother in Atlanta works 2 jobs. One as a medical assistant, 1 weekend shifts at a retail chain. Her rent went from $1,100 to $1,450 in 2 years. She asked her landlord if she could sign a longer lease for a smaller increase. He said no. She looked for cheaper apartments. Everything within 30 minutes of her daughter's school was the same price or worse. She thought about moving farther out, but her car is 12 years old and barely running. A longer commute means more gas, more wear, more risk. She stayed. She picked up a 3rd shift. Her daughter now stays with a neighbor after school 3 days a week. She's working 60 hours a week to afford the same apartment she had 2 years ago. Geography deepens the divide. In cities, rents are crushing. In rural areas, wages are lower and rental stock is scarce or substandard. The middle has hollowed out. Small towns that once had affordable apartments now have waiting lists or nothing at all. Developers won't build there. Profit margins are too thin. So people stay in places with no jobs, or they move to cities where rent devours half their paycheck. Either way, they lose. The renters hit hardest are the ones the economy claims to need most: teachers, nurses, paramedics, grocery workers, childcare providers. The people who keep communities running. They can't afford to live near the places they serve. A firefighter in Austin rents a 2-bedroom an hour outside the city because nothing closer is affordable on his salary. When he's called in for an overnight shift, he pays for overnight childcare or asks his retired mother to drive in. A home health aide in Seattle shares a basement apartment with 2 other women because a place of her own would cost 70% of her income. She sees clients in mansions worth $3 million. She makes $19 an hour. The disconnect isn't subtle. It's grotesque. According to housing research centers, the number of Americans spending more than half their income on rent has increased by over 40% in the last decade. These aren't people living beyond their means. These are people whose means have been severed from the cost of shelter. The American economy depends on their labor, but it has priced them out of stability. And when renters are squeezed, everything else compresses. They don't start businesses. They don't save for education. They don't invest. They survive, month to month, lease to lease, forever one emergency away from eviction. That's not mobility. That's precarity. The ripple effects are structural. When renters can't build wealth, they can't weather shocks. Medical bills, car repairs, job loss, events that a homeowner might absorb with a home equity line or emergency savings become catastrophic for renters. Eviction filings have surged in many cities, even as pandemic protections have expired. Once someone is evicted, the mark on their record makes it nearly impossible to rent again without a guarantor or paying months up front. They move into cheaper, more unstable housing, or they double up with family, or they cycle in and out of homelessness. The cost of renting becomes the cost of instability, which becomes the cost of survival. Cities feel it too. Renters are more transient, less invested in local institutions, less likely to vote in municipal elections or serve on school boards. Neighborhoods with high renter turnover see less social cohesion, fewer block parties, weaker networks. That's not a moral judgment. It's a function of time and security. When you don't know if you'll be there next year, you don't plant roots. Local governments lose tax revenue they'd gain from homeowners, and they spend more on services for unstable populations. It's a fiscal drain with no easy fix. Some cities have tried rent control. Landlords respond by converting units to condos or letting properties deteriorate. Some have offered first-time buyer assistance. It helps a few thousand people, but millions remain renters. Some have pushed for inclusionary zoning. Developers fight it, or they build the minimum required units and charge market rate for the rest. Every solution is a band-aid on a system that's fundamentally broken. A retired veteran in Florida lives on Social Security and a small pension. His rent has gone up 30% in 3 years. He can't move. His doctor, his VA clinic, his friend group are all nearby. He started skipping medications to make rent. He's 71 years old. He served his country, and he's choosing between housing and health because the rent won't stop climbing. Some landlords have tried to adapt. They've offered payment plans, frozen rents for long-term tenants, or waived late fees. But those are individual acts of mercy, not systemic solutions. The incentives are stacked the other way. Institutional landlords answer to investors who demand returns. Small landlords face rising property taxes, insurance costs, and maintenance expenses. Everyone passes the cost to renters because renters have no choice but to pay. A few companies experimented with rent-to-own models, where a portion of monthly rent goes toward a future down payment. It sounds promising until you read the fine print. Renters must stay for 5 to 7 years, meet strict payment deadlines, and qualify for a mortgage at the end, often with the same house priced higher than it was when they started. Most don't make it. They move for a job, miss a payment during a medical crisis, or can't secure financing. The equity they thought they were building vanishes. The programs aren't designed to create homeowners. They're designed to extract more rent under the illusion of ownership. Even government programs have failed to scale. Housing vouchers cover only a fraction of eligible families due to funding limits. Public housing waiting lists stretch years, sometimes decades. Affordable housing mandates are met with lawsuits and delays. The infrastructure to support renters barely exists, and the infrastructure to transition them into ownership is nearly non-existent. Meanwhile, the wealth gap widens. Homeowners, even those who bought at the peak, have seen their net worth grow as home values appreciate. Renters have seen their savings erode as rent consumes more of their income every year. According to data from the Federal Reserve, the median net worth of homeowners is over 40 times that of renters. That's not a gap. That's a chasm. And it's generational. Parents who rent can't help their kids with college or a first home. The cycle repeats, deeper and harder each time. What does it mean to be American when the foundation of the American dream, homeownership, has become unreachable for tens of millions? Renting used to be a chapter. Now it's a life sentence. The identity of the renter has shifted from transient young professional to permanent underclass. People in their 40s and 50s, raising families, building careers, are still renting. Not by choice, but by necessity. The narrative that renting is a failure of personal responsibility is a lie that benefits landlords and investors. The system isn't broken by accident. It's working exactly as designed, to concentrate wealth at the top and extract it from everyone else. Renters are told to budget better, spend less on coffee, skip vacations, drive older cars. But you can't budget your way out of a rent increase that outpaces your raise. You can't save your way out of a housing market that rises faster than your income. The advice is gaslighting dressed up as financial literacy. The real cost of renting is the future you don't get to build. It's the security you can't create. It's the freedom you were promised but never received. It's watching your paycheck disappear into someone else's asset while you're told you're not trying hard enough. A renter in Oregon works in tech, makes $80,000 a year, and still can't afford to buy in the city where her job is. She's been renting for 12 years. She's paid over $150,000 in rent. If that money had gone into a mortgage, she'd own a home. Instead, she owns nothing. She's one lease renewal away from being priced out entirely. This is the reality for millions. The cost isn't just financial. It's existential. The future of renting in America is more of the same, only worse, unless something fundamental changes. More people will rent longer. More wealth will concentrate in the hands of those who own property. More families will be locked out of stability. The mechanisms are entrenched, the incentives are misaligned, and the political will to fix it is absent. Rent will keep rising because it can. Wages will keep stagnating because they have. The gap will keep widening because no one with power has a reason to close it. This isn't speculation. It's trajectory. What's already happening in coastal cities will spread inland. What's already normal for millennials will become normal for Gen Z and beyond. Renting won't be a phase. It will be the default. And unless we recognize the real cost, not just in dollars, but in opportunity, security, dignity, and future, we'll keep pretending this is sustainable. It's not. The system is eating itself. Renters are paying the price. And the bill is coming due for all of us, whether we rent or own, because a society that can't house its workers is a society in decline. The real cost of renting in America is the America we're losing. The question isn't whether you've noticed. It's whether you're willing to see it. These patterns aren't abstract. They're in every town, every paycheck, every lease renewal that feels like a punch to the gut. What's changed where you live? What disappeared first for you or someone you know? Tell us below.